Welcome to the Spreadex weekly financial trading preview. I'm joined again by Analyst Connor Campbell, and we're going to start by looking at a potentially record-breaking FTSE.
Yeah, it's interesting. It's sort of the FTSE could end up breaking its own record. I think it's set back in mid-January. It came within a hair's breadth of 7,800. At the moment, it's around 60, 50 points away from that mark. But without, it'll be one of those record-breaking weeks without actually that much to send the FTSE to those highs. I think, Tuesday's wage growth data was sort of the big focus for the week. But beyond that, there's nothing really for the FTSE to get its teeth into. I think the main thing for the FTSE then going ahead will be the performance of Brent crude. If Brent crude and oil in general keeps climbing higher, then the FTSE stands a good chance of getting towards that 7,800 mark. Interestingly, our clients aren't really a fan of the FTSE above 7,700 since it's hit that point, which I think is 17 week high for the FTSE, obviously then heading up to that all-time high. They're just not a fan of the index at those levels. I think perhaps because even if it does end up hitting that all-time high, it didn't last very long there back in mid-January, and I think they're perhaps concerned that if it, from now on, or if it does get to those levels, it could just pull back quite sharply, especially since there isn't anything at the moment beyond the weakened state of the pound to really propel the FTSE much beyond that previous all-time high.
Yeah. Okay, and then looking at some stocks this week, so we've got Wednesday, we've got Burberry.
Yeah, Burberry, they've had quite the swing this year. I think it was back in early February they were at 13-month lows, then at the start of May they were up to 6-month highs. And that swing largely based on the announcement that former Givenchy designer, head creative there, Riccardo Tisci, was taking over as the head of creative at Burberry. That's replacing Christopher Bailey. He was former CEO, then he left as creative director. He was announced he was leaving as creative director last year. And that's been seen as a fairly bold appointment by Burberry. It's a traditionally British brand, and even though it sort of sounds silly to make a point of an Italian being appointed head of creative, that does seem to have been something that investors have been pleased by, and a shake-up that perhaps Burberry needs if it is going to head on to the sort of the super luxury brand, the super high-priced products that it is intending to do. Yeah. In terms of its actual financial performance, things are a bit more mixed. I think earlier in the year, its sales for the third quarter, I think, were up 2%, which wasn't as strong as the 3% forecast, and way down on the previous year's figures. That's mainly due to a huge drop-off in the number of high-spending Chinese tourists coming over to take advantage of the weakened pound. Obviously, the pound not doing great at the moment, but there were points this year where it's been a lot stronger, and I think that has probably impacted the performance of Burberry. And it's sort of global performance because it was really, really benefiting from that weakened sterling last year. In terms of what it's going to post on Wednesday, it's its full year figures on Wednesday. I think revenue is expected to be roughly flat at around £2.73 billion, but with adjusted operating profit falling just over 1% to 453 million. So there you haven't got a lot of great figures for investors to deal with. I think obviously since it is at 6-month highs as well, there's that added pressure to justify the sharp rise in price in the last few months. I think that's why we've seen our clients selling above the £18 mark. I think they're looking at these prospective figures and thinking perhaps Burberry hasn't got it in it to justify its current price at the moment.
Okay. And then looking onto Thursday, we've got Royal Mail.
Yeah, Royal Mail's had an absolutely fantastic 2018. I think it's up 39% since the start of the year. And that's following on from a strong end to 2017. But, I think it's now at all-time highs. That's from all-time lows in last November. So it's been quite the turnaround without necessarily a huge shift in its financial performance. I think it was its 9-month, trading 9-month update back in January. I think overall revenue was up 2%. But it was flat in the UK. That was because parcel revenue was up 4%. That accounted the 3% drop in letters revenue being a key issue for the company in the last couple of years and likely going forwards. However, then at GLS, which is its Europe-focused arm, I think volumes and revenue were both up 10%. So there again is really robust growth for investors to sort of pick up upon if they're feeling positive towards the stock, which they have clearly been in the last few months. The main issue for the company, though, came at the start of February. It finally agreed to deal with the Communications Workers Union, which was, that had been hanging over the stock for a while now. issues, I think investors were really worried about the impending strikes and the previous strikes that had gone on about its pension scheme and things like that. So the resolution to that was giving it a huge boost since the start of February and sort of sent it propelling towards these all-time highs in the last week or so. In terms of its figures this week, I think the main figure looks to be group operating profit after transformation costs. I think that's meant to be up 39% to £680 million, which is a really strong figure that should help perhaps overcome some of the letters issues that are likely going to be in the news come Thursday. I think revenue is also expected to be up 4% to £10.2 billion, which again, very strong numbers. However, a bit like Burberry, our clients have been selling Royal Mail around between 620 and 640, just because, it's up 39% since the start of the year. It's at all-time highs. That leaves the company with a very slender margin of error heading into its full year figures on Thursday. One bad number could put investors off and drag it back towards, say £6 or something like that.
Okay, and finally we'll finish with Thomas Cook.
Yeah, Thomas Cook again, another company that's doing pretty well at the moment. Highs not seen for a while. I think it's trading above 140, which are levels it hasn't seen since July 2015. That was around when things like sort of global terrorist attacks and things like that, and the impact of Brexit really began to, in the last couple of years, really began to impact on the stock. Seems to be in recovery mode at the moment, though. Investors seem to be receptive to what it's doing. Interestingly, the thrust of that growth this year has come from a pair of ratings upgrades, I think, from Jefferies and Credit Suisse. Because before that, its first quarter results earlier in the year weren't greeted with too much glee by investors. I think their headline figures were strong. Bookings were up 8% for the first quarter. Revenue was up 7% to, I think it was £1.75 billion. Strong numbers. However, its gross margin dropped 50 basis points to 21.5%. That was mainly due to higher cost inflation in Spain, which is, ultra competitive market. It's one of those things that the company can't afford to not, go fully headlong into, but is also can cause issues like with margins and things like that. There was also a comment from the CEO saying that whilst it's in an encouraging start to the year, the CEO sort of lamented the highly competitive and at times predictable market that Thomas Cook finds itself in. I think he used the example of the multiple airline carriers that had collapsed in the previous months to illustrate that point. In terms of its figures heading into Thursday, its second quarter figures, I think investors are basically just going to want to see the company avoid another dip in gross margin, basically, for the second quarter. I think the company did say that to try and combat the situation in Spain, it was going to try and pivot more towards higher margin destinations like Turkey and Egypt, which again are sort of destinations that suffered in the last few years, but seem to be picking up now. Tourists seem to be more willing to go back to those countries. From a client's perspective, interestingly, despite being in a similar situation to Burberry and Royal Mail in terms of being a multi-year highs, our clients are more receptive to Thomas Cook at the moment. I think they see it's got perhaps a bit of a more way to go with its current climb. They're buying around the 140 mark heading into the second quarter figures on Thursday.
Okay, very good. Thank you. That's all for this week.